people. We believe that all businesses are ultimately a collection of people and ideas, and we aim to align ourselves with intelligent owner operators and investors with successful track records. I think that's pretty self-explanatory, and I'll talk a little bit more about that later when I talk about idea generation. Two, fundamental business analysis. We spend a lot of time studying the businesses that we own. We want to know, how do those businesses make money today? How will they grow revenue and earnings in the future? And, simply we consider ourselves business people who merely transact through those publicly traded securities. And we don't view stocks as pieces of paper that trade up and down, but instead of fractional or equivalent ownership stakes in those companies. And then finally, value investing. We are value investors at our core. But I also feel like, value investing is probably an overused term, and there's such a big, broad range of what value investing means. We believe that all investing is value investing. And, the thought of buying an asset just because it's cheap that doesn't necessarily make a lot of sense. And, buying an asset that's growing that is too expensive doesn't make a lot of sense either. So, simply we don't want to overpay for the assets that we own. But I think what's really important is we spend a lot of time trying to understand the catalysts that will unlock that value. Cheap stocks are usually cheap for a reason, and they stay cheap. So like I said, we really try to identify those catalysts that will unlock that value. On this page, we talk about our investment process, kind of our starting point being the proxy statement. And not all ideas are, is the proxy statement necessarily the starting point. But I think the important thing to know here is that in every company we own, we usually end up back at the proxy. And the key point here is that we really only want to own companies where management has more to gain or lose through their ownership than they do through their compensation. And down here, there's 4 pictures of business leaders that kind of pass that proxy test. You could see in the center left here, this picture of John Malone. I'm sure many of you listeners are familiar with John Malone and Liberty Media, but this is a little dated, but from this proxy a few years ago, you could see that his salary and bonus was about $700,000, and his stock ownership in the company was $1.4 billion. The picture next to him, Prem Watsa, known as the Oracle of Ontario, he's the chairman of Fairfax Financial. His salary plus bonus a couple of years ago was around $600,000. His stock ownership, $1.2 billion. So, I think the thing to really take away from there is without knowing anything else about these companies or these gentlemen, they care more about that stock price than they do their take-home pay, and that alone aligns them much more with stockholders and stakeholders than the vast majority of companies. And I would just say that this alone doesn't mean that these are good investments. Doesn't mean that we would necessarily own these companies, but it's a great starting point. And I would argue, why would you want to own a company where these dynamics weren't part of the equation? Next year on this slide, I talk a little bit about how we typically generate ideas, how they come into our focus, and we talk a lot about how there's thousands of publicly traded companies. And you want to make sure that you kind of, you've heard the term fish where the fish are, and spend most of your time on ideas that will end up being actionable. So you could see here on the top, one way in which we oftentimes generate ideas would be through our daily work on SEC Form 4 filings, 13D filings, 13G filings, 144 filings. But just as an example, when an insider at a company, CEO, chairman, someone that's part of executive management, someone on the board of directors, buys or sells stock, they have to file what's called a Form 4 with the SEC, and that's public information within 48 hours. And, rather than, reading some sell side research report or sourcing ideas from some financial publication, it just makes sense to us that you might find actionable ideas, this way. And just because a CEO or someone on the board, writes a check buying $2, $3, $4 million worth of stock with their own after-tax capital, that doesn't mean we're going to follow them into that idea. That doesn't mean that the idea is actionable, but maybe we should spend a little bit of our time trying to see if we could see what they do, and to kind of step back and give you a kind of a little bit of a story of why that is such a important part of idea generation for our company. Our chairman and chief investment officer here at Old West is my dad, Joe Boskovich Sr., and he entered the investment management business 25 years ago. Prior to getting into the investment business, he ran a family-owned farming and food processing operation called Boskovich Farms. At the time, Boskovich Farms, they were the largest client to a small regional Southern California-based bank called Santa Clarita National Bank. And the chairman of that bank thought it'd be a good idea to have board representation from our family business on the board. And he invited my dad to join the board in his late 20s, early 30s. And my dad recounts going to these quarterly board meetings, and every quarter there was always a page of the board book dedicated to stock transactions throughout the prior quarter. And it was a very thinly traded bank, so there wasn't much stock that traded, but anytime there was any stock that traded, he always noticed it was the chairman of the bank buying that stock. And he witnessed this quarter after quarter after quarter after quarter, and finally approached the bank chairman and asked if he could buy stock alongside of him. He, bought a fair amount of stock for someone in his late 20s and early 30s. Well, fast forward several years, Santa Clarita National Bank sold to First Pacific Bank, which then sold to Bank of America. And my dad made quite a bit of money for someone in his, I believe, mid 30s by that time. But the point of this all is that no matter how much you think you know about a company, no matter how sound and rigorous your analysis is, maybe you don't know as much as the people running that business. And I think that's something not to forget, because this is a business where I think you have a lot of smart analysts, smart people that think they know more about that business, including the people running it. So this whole concept of watching what insiders are doing with their money rather than listening to what they're saying, that's a very ingrained concept in our DNA. Two here, we talk about how every quarter we scour through a number of 13F filings, looking at what other investors are buying into their portfolio, what they're increasing, what they're decreasing, and kind of monitoring some of that activity. And I think the concept here is that we don't have a monopoly on all great ideas. And I've been in this business for about 20 years, and I will tell you that on the investment side, one of the kind of intangibles that I hold nearest and dearest to me is the network of other investors that I've built. Other investors that I think are really smart, work really hard. There's a lot of diligence that goes into their work. I think it just would make sense that you would pay attention to what they're buying. I'm sure you've heard about a lot of great business leaders that talked about the value of reading books, right? And you might have an author that he has spent, months, most likely years, maybe decades of his life, putting everything in his heart and in his head in that book, and reading that and soaking up that person's lifetime of experience. There's probably not a better return in terms of time spent. So, same here. I think there's companies where there's other investors, like I said, that I think are very savvy, and they've spent hours, maybe months, maybe years, maybe decades learning a company, and to monitor what they're buying through their quarterly 13F filings or, talking to them and having a regular dialogue just seems very smart. Third here, we talk, once again, I mentioned this earlier, but, doing a lot of business analysis, understanding the businesses, understanding the industries in terms of the ecosystems that those businesses operate in. How do they make money? How are they going to make money? We read industry periodicals, talk to customers, competitors, suppliers, but really trying to understand that business landscape. And then finally, we look at special situations such as spinoffs and companies and or industries that have undergone sharp corrections or prolonged downturns that mask underlying value, where we can understand why that company is structurally misunderstood and mispriced. We look for companies, kind of focus on companies that have some sort of structural growth tailwind. And I would also, asymmetric upside. I think a lot of our investments have this huge asymmetric upside where, we feel that the risk we're taking owning that investment is far outweighed by the giant upside. In terms of looking for investments, like I said, focusing on special situations like spinoffs, and there's a variety of other special situations, but where we could understand why something is misunderstood or mispriced, I think is very important. This is a very challenging business, and I think it's important to understand that when you buy a stock, you're buying that stock from someone selling it to you. So, really you're kind of making a judgment that you know more about that company than the person selling it to you. And I think when you focus on a lot of, big companies that are widely owned, that's kind of a big assumption. There's a lot of smart people. Why do you know more than they do? And I think when you focus on certain companies where it could be a number of things, maybe institutions can't own it because the company is too small. There's a number of different things, but really try to understand why that business is on sale. So with that said, I thought we'd kind of jump into our portfolios. So our biggest exposure in our portfolio currently is to a basket of uranium mining companies. I wrote down here some of the largest exposures. Cameco Corporation, which is the largest North American producer. NextGen Energy Fuels. Energy Fuels is one of the only producers here in the United States. Centrus Energy, they are actually an enricher of uranium. But you could see that, and there's a couple of others that we own, but you could see that that's currently 35% of our capital in our main fund. But uranium, it's a commodity. It's a commodity where demand is much, much, much greater than supply, and more supply needs to be brought online to meet that demand. But in order to bring new supply online, producers of uranium need to be incentivized with prices that are at least 100% greater than the current spot market price. And so it's going to be really interesting, and we expect big things in this space. I would also note that this has become such a large conviction of ours that well, I guess first off, our work in this uranium mining industry, most of it is driven by my business partner Brian Lax, who, if you have an interest, I would recommend that you get on the phone with him. I do not think there are many people in the investment management business that understand this industry and have done more work on this industry than Brian. Actually, to the point where a couple of years ago, we launched another fund, which is a clean energy focused fund, which is currently just about all focused in the uranium sector. And like I said, we expect big things out of it. So on this slide, what is uranium? So uranium is the feedstock used to fuel nuclear power plants. Nuclear energy currently produces 11% of the world's electricity and 20% of our electricity here in the United States. And I think it's probably also important to note that close to 60% of our clean energy is generated from nuclear power. Taken together, there are about 30 countries that use nuclear energy, and the biggest users would be France, which gets almost 80% of their energy from nuclear power, and then there's a number of other countries like Slovakia and Sweden and Switzerland that are close to that 70% electricity from nuclear. And by the way, as I'm sure a lot of you have read, those are also the countries that have the cleanest climates. So nuclear energy, it's the only carbon-free source of electricity that can be ramped up to massive scale because it's not intermittent, meaning that it's the only carbon-free source of electricity that can run just about 24/7. Wind only works when it's windy, solar only works when it's sunny, hydro needs to be near water. But like I said, nuclear energy could run just about 24/7, and it's the only carbon-free source of electricity that can do that. And then I would also, note that as a fuel source, its performance is unmatched. I think this is an interesting, visual down below, but you could see, the size of a nuclear pellet, and one tiny nuclear pellet is the equivalent to 1.7 tons of coal. So a kilogram of uranium can provide 1 million times the energy of an equivalent mass of natural gas and 3 million times that of a kilogram of coal. I would also note here that, and I think this is important because a lot of people are misinformed when it comes to nuclear energy, but it's the cleanest and safest form of energy production. The more that people learn about nuclear power, the more supportive they are. And you can see these two diagrams down below. The first one on the left, it's like I said, it's the cleanest form of electricity, and it's carbon free. And on the right here, you can see that it's the safest too, and there's fewer accidents than all other forms of energy production. I mean, just for an example, nuclear power releases less radiation into the environment than any other major energy source. They say if you live next door to a nuclear power plant your entire life, you would be exposed to less radiation than on a single flight from Los Angeles to New York. So like I said, I think there's a lot of misinformation about nuclear, a lot of fear mongering, but that's quickly changing. You see, both political parties have really adopted it as the fastest way to slash greenhouse gas emissions and decarbonize the economy. So really fast, why does this opportunity exist? Why are people selling these equities to me at such a cheap price? Well, if you go back to March 2011, there was a magnitude 9.0 earthquake off the coast of Japan, and there was a tsunami that followed, and that flooded the Fukushima power plant. At the time, Japan had about 50 reactors that represented over 10% of the global fleet. And as a precaution, Japan took their entire nuclear fleet offline. And so that really almost overnight threw the industry into the situation where there was now excess supply. And, that excess production and inventory level caused a severe decline in the price from roughly $70 a pound. And it reached, I think as low as $15 a pound, which was significantly below the cost that miners need to produce the metal. And it really made mining uranium completely uneconomical. And as a result of that price collapse, that has led to huge production cuts. And this prolonged environment has lasted the last decade. At the peak of the last high in the uranium market, there were about 500 uranium resource companies. Well, today there are about 40. This was a $150 billion industry 10 years ago. It got as low as $5 billion. So once again, why are these companies being sold to me at such a cheap price? Well, at such a small industry, $5 billion, now it's probably about a $7 to $10 billion industry. This is uninvestable for most people, for just about all institutions. And if institutions can buy it, it's Kazatomprom or Cameco, which are the two largest producers, and the other are definitely uninvestable just because they're so small. So you've had all these companies go away. now very concentrated in just a handful of producers, developers, or explorers. And then I think it's important to note that the surviving producers have also been forced to suspend production. So Kazatomprom, which is the state-sponsored entity in Kazakhstan, and they're the largest producer of uranium, they've announced significant supply cuts. And then Cameco Corporation, which is a Canadian-based public company, they're the second largest producer. They shut down their largest mine, McArthur River, completely took it offline indefinitely. And so you've had this huge supply cutback. And I would also note that Kazatomprom and Cameco combined represent roughly 60% of global production, which is just that's just mind boggling when you think about 60% of production comes from two producers. So with that $25 million supply coming offline, we point this, it's written here in the presentation, but we pointed off that represents about 20% of global supply. So, to put that into perspective, that would be the equivalent of Saudi Arabia and Russia completely ceasing oil production. You imagine what would happen to the price of oil if that were the case. If you go to the next slide here, so now you have this significant supply deficit, and meanwhile, reactors are being built globally at a pretty fast pace. So, once again, when you get back to what we look for in companies, so not only do we look for companies where, that have maybe gone through this prolonged downturn or a sharp correction, but also looking for companies where there are structural growth tailwinds. And that's definitely the case in uranium. You can see that there are about 450 operable nuclear power plants globally, but you have about another 500 that are either under construction in the proposed, ordered and planned stage and proposed stage. And China will be tripling their nuclear power capacity over the next 10 years. India will be bringing on 21 new plants in the next 10 years. Japan is bringing on many of the reactors that they originally shut down. So it is a growth industry. And here you could see on this slide that is triggering a cycle shift. The uranium deficit is here, and history tends to repeat itself. You could see on this graph below what has happened to the price of uranium when this industry has swung into a supply deficit before, and we are entering the biggest supply deficit we've had. The level of demand is going to require much higher prices to encourage new sources of supply. On this slide, I would just point out that the uranium market is unique in that it is characterized, there are two different prices to look at. So you have the long-term contracting price and you have the spot price. Well, 90% of uranium is traded at the long-term contracting price, and that is the price that is agreed between the miners and utilities. These are characterized by long 7 to 10-year contracts, and most of these were entered into, preceding the March 2011 Fukushima accident, and they've begun to roll off. And the utilities are needing to enter into new contracts with the miners to secure new supply. What they have been doing the last few years is rather than producing new uranium, the miners have just been buying off the spot market and delivering that material into their long-term contracts. And there is evidence that there is very little supply left on the spot market, and it's a very shallow market. There's not a lot traded there. So as contracts are entered into, we believe that prices will not only rise, but they'll rise significantly. As I mentioned, the producers need 2x or more just to break even on new production. And then finally, I think this is really important too, because the buyers are price insensitive. You could see that the typical cost of constructing a nuclear power plant is between $5 and $10 billion. Well, the annual uranium need is only 15 million. So these utilities, they're going to buy, and it really doesn't matter what the price is as they start entering into new contracts. And we believe that that is imminent and right around the corner. So once again, as I started, we have really, approached this exposure through buying a basket of the miners. The miners are extremely levered to a rise in prices. And as the uranium prices rebound, the demand for uranium miners, coupled with a lack of supply, will exaggerate the share price increases of equities. So we're invested in a handful of names, a basket of uranium companies, and the landscape consists of companies that can be categorized as producers, developers, and explorers. And we own the companies that represent the very best projects in all stages of development and that are led by good management teams with significant interest. So if you look at this graph below, Global Atomic, Vimy, Denison, Fission, GoVX, Bannerman, a lot of those we just owned in our uranium, in our clean energy fund that's dedicated to uranium. But NextGen, for example, that's one of the names that we own in our main fund, and it's a significant exposure. So just as a case example, it is in a safe jurisdiction, high grade. You can see 300 million pounds of resource. It's the largest undeveloped uranium deposit in the world. And it's amongst the highest grade zones in the world that close to 20% uranium, which is more than 100 times the world average. You can see here, we put the market cap and compare it to the project net present value, but at $50 uranium, and we feel very confident that the price is going, the long-term contracting price will get there. It has to get there. The project has a net present value of $3 billion, over 5x the current enterprise value. So we expect this to be a huge investment for us, and as do we the names that we own in the basket. And then earlier I talked about management and how management is paramount. And you could see here that the CEO has a substantial stock position, and they receive a significant portion of their pay, incentive pay, in stock. And then I think this is very interesting that in the last few years, Li Ka-shing, who is one of Hong Kong's richest men, took a 20% ownership stake in the company. And we find that all, very interesting and has increased our conviction in a name such as NextGen. So, that's uranium. That's 35% exposure in our fund. Next year, you can see we have gold miners. I didn't write the percentage here, but our basket of gold miners is about 25% of our fund. So, right there, that's 60% of our fund, uranium and gold combined. But with gold, central banks around the world are printing their currencies as fast as they can, and there's no end in sight. We don't know. None of us know how this turns out, but this could very easily lead to hyperinflation and really a destruction of wealth for anybody that holds for savers and people that own fiat currency. And if you look at this slide here, fiat money versus gold, John Maynard Keynes, this is a great quote. I like this quote. By a continuing process of inflation, government can confiscate secretly an important part of the wealth of their citizens. Warren Buffett talks about how, inflation is the cruelest form of tax that fewer than 1 out of 100 Americans understand. Or, I'm sorry, 1 out of 1,000,000 Americans understands. And then this quote from JP Morgan's great: gold is money, everything else is credit. And once you realize this, you will never be poor again. I love this visual right here on the left of this dollar bill. You could see that back in 1913, if you had $1, it was worth $1. Today, it's worth about 5 cents. But since the beginning of time, fiat money has always failed throughout history due to the same pattern of rapid devaluation. And I think in order to stop the dollar from falling further, the market needs to let market interest rates rise significantly to rebuild confidence in the dollar, and we can't afford that. We tried to go up to 2% a couple of years ago, and the market fell 20%, and we're basically trapped at 0% because of the enormity of our debt. And you could see that once again, that visual of the dollar has lost 98% of its purchasing power since 1913. And if you look at the graph below that, I think this is also a great visual. So, not only has the dollar lost 98% of its purchasing power since 1913, but gold has increased more than 60x in value during that same time. And gold has been valued as it has been valued for as long as human civilization has existed. No monetary good has a history as long and storied as gold, and gold is a physical, tangible, and real asset, and we view it as a currency. Um, this is a great little timeline, I think, of the Federal Reserve balance sheet. And like I said, we have unprecedented money printing by central banks, and we don't know how it ends, but it could lead to hyperinflation. So I think it's a great protection in the portfolio. And if you start at the beginning here in 2008, the Fed had an $800 billion balance sheet, and then in response to the Great Recession, low interest rates wasn't working, so we experimented with quantitative easing and launched QE1. And that was, in 2009 and 10. And then in 2011, we followed up with QE2. And then in 2013, 14, we followed up with QE3. And then after pausing for a while, we sat there and tried to walk back some of that stimulus in 2018. And you guys all remember what happened in 2018, but the Fed aborted its attempt to normalize interest rates and shrink its balance sheet. And they quickly reversed course and began cutting rates in early 2019 when the stock market fell 20%. And, then we had, I'm of the feeling that this coronavirus really, you've heard a number of people, talk about this, but really what coronavirus is it was the pin that pricked the bubble. And if it wasn't for coronavirus, something else would have pricked the bubble. And to pop that bubble from deflating, the Fed came to the rescue again and announced QE4 or QE infinity, as we know. And what's really interesting is there is more quantitative easing in QE4 than in all the other QEs combined. I think this is, so we had like I said, we had an $800 billion balance sheet in 2008, went to 4 trillion, try to normalize it. And, now we're sitting here with a $4 trillion balance sheet. We're running $4 trillion deficits. And I think this is an amazing stat. But you can see here, 60 cents of every dollar being spent by the government is being printed. And that is, just think about that. 60 cents of every dollar being spent by the government is being printed. So I think you're fooling yourself if you think we will be able to crawl out of this debt. I think it's just going to get more and more and more, and gold is a phenomenal protection. And this next slide is great because we talk about insider buying and watching insiders, and in this instance, I think the ultimate insider buying are the world central banks. Central banks are buying their most gold today than at any point since 1967. They know that their efforts to pump liquidity is failing and has created significant consequences as the utility of that money continues to diminish. Gold, as we mentioned, we believe it continues to have intrinsic value, so it reassures countries, especially if they fear inflation and downturns. So gold investments, once again, we own a basket of gold mining stocks. I think it's gold exploded higher during QE1 and QE3. And, I think you look at gold miners today, we feel that gold miners will be one, if not the only industry showing strong earnings growth, for years to come. If you look at, recent quarterly numbers for the miners, they've been great. And that, was with gold averaging, less than the $1,900, $2,000 an ounce it's trading at now. Most gold miners are sharply raising dividends. Imagine that, companies raising dividends every quarter during this, pandemic period. And then, gold miners today, they're, like I said, they're trading about $1,900, $2,000 an ounce. And the best gold miners, a lot of the ones that we own, they have $900 average all-in sustaining costs. And these companies have higher margins today than they have, at any other time in their history. So we think the gold bull market is here, and the amazing thing is these miners are nowhere near the levels they attained, during the prior bull markets. And this is a great graph showing that how gold rallied to new all-time highs well before the S&P recovered. And I know the S&P has recovered, but we think that is fake, and it's been engineered by the central banks. So I've talked about two major themes in the portfolio, where baskets of companies, call it 10, 12 different companies, make up 60% of the portfolio. And now, I'll turn to some, names that are very fundamental, bottom up, owning specific companies. This is a company that I am just, incredibly excited by. It's an 8% position in our portfolio. It's one of my favorite holdings. And I think at first, just give you a little bit of corporate background and how we became interested. But let me go back here. So Wildbrain, what it is it's a kids content company. They own IP. They partner with IP. They create cartoons for those IP. They distribute those cartoons to linear broadcast networks, to the major SVOD platforms, and on their own AVOD network. And then for a second income stream, they licensed that IP to toy companies, and about 1 million other consumer products outlets, which is tremendous high margin business. And you'll see why I think that this stock could just do tremendous over the next couple of years. A little bit of background on the company. In 2006, there were two Canadian-based children entertainment companies that merged. And over the next over the next 10 years, they kind of went on a buying binge and rolled up a bunch of different smaller kids content companies. And although that roll-up strategy, I think, assembled an incredible portfolio of IP, it lacked vision for managing, developing, and nurturing that content. And I think it's important to know that prior management lacked the experience needed to develop that 360-degree approach from content production to brand licensing in order to push the IP through every stage of brand extension. So that's why I think such a great company is available at such cheap prices. I think a lot of people have been turned off by this name, but it's a very different company today. So how do we become interested in this company? I think this is interesting because if you go back to idea generation, you'll recall that one of the ways we generate ideas is looking at the 13F filings of investors that we have a high regard for. And there is a fund out of New York called Fine Capital Management that was started by Deborah Fine, who used to run family office for the Tisch family. And the current CIO of that company, a gentleman by the name of Jonathan Witcher. I've followed him for some time. I think they are a very, very smart group. They do tremendous work. And once again, I think it's a no-brainer to at least be aware of what they own. So it first came to our attention in 2015. Fine Capital pitched. At the time, the company was called DHX Media, as I just mentioned, and they pitched it at the Sohn Conference in New York. I thought it was very interesting. Kind of the gist of the pitch was, kids content never grows stale. A new generation watches it over and over and over again. Lends itself to consumer products more than other content, and that's high margin business. And it all made sense to me, and I loved it. At the time, though, the company's flagship brand was a piece of property called Teletubbies, which some of you may be interested or familiar with. And, although extremely popular and profitable as a brand in the 2000s, I had some reservations regarding the evergreen identity of that IP. And so we passed. And but always kept an eye on the company and watched it, monitored it, and our feelings on the company began to change in 2017 when DHX Media bought the Peanuts franchise, Charlie Brown, Snoopy from Iconics Brands. And, we believed that Peanuts was an evergreen franchise. And although it, kind of reached its peak of popularity decades ago, and there has not been really new, fresh, exciting content, I think that Peanuts has proven to be one of the top family brands worldwide. Just if you look at consumer products revenue, I think it's the number 6 family brand worldwide. So the evergreen status can't really be argued, in my opinion. And then upon deeper analysis, what we did realize is that, DHX Media, what we quickly discovered was that they had a breakout business that at the time it was in its infancy and just starting. And I think this is important because, as I mentioned, we want to find companies with great management teams. I didn't really talk a lot about competitive moats, owning great franchises, but that's an important criteria. Valuation's obviously important, but if you recall earlier, I talked about how we look for cheap companies, but that have some sort of structural growth tailwind. And I think oftentimes that can be found in businesses that have a breakout business from within, where everybody's focused on the core business, but they have this tinier breakout business that is just growing rapidly. And that's the case in WildBrain or DHX Media. At that point, they had a breakout business, a subsidiary called WildBrain. And that, like I said, it was in its infancy, and that was its AVOD business, where they were creating content for all the different AVOD services such as YouTube. And actually, they're now the largest creator of kids content on YouTube and other AVOD services. We'll talk about that a little bit later. But as we discovered that business, and then you discover that it had an award-winning brand licensing agency attached to it called CPLG, and really what WildBrain is, and I believe this to be the case, and I'd love to talk to anybody about it more, but it's a vertically integrated business where it controls the entire supply chain. They own or partner with the IP. They distribute it through WildBrain Spark, their AVOD business, and then they control the consumer products licensing as the agency manager. That is such a rare quality to find in businesses, and the businesses that truly do have that vertically integrated component, those are often the 10, 20, 30, 40, 50 backers that we love to find. And I wouldn't be surprised if that was the case here with WildBrain. And then really where our conviction, hold on, this stopped sharing. I apologize, Graham. How do I share it again?
It looks like we're still seeing the presentation on our end of things.
Let me pull this up really fast. Okay, I apologize.
No problem.
Okay, here it is. Now I have it on the full screen. So where our conviction in this company really changed big time was about a year ago, and that's really where we went all in. We talk about management. Oftentimes, I think the catalyst for unlocking value that I talked about earlier sometimes is apparent in new management teams. And in August 2019, DHX Media named Eric Ellenbogen as the CEO. I'll talk about him a little bit in a second, but he has a proven resume in kids content. So that was mid-19 that was mid-19 and early December 19, DHX Media delisted from the NASDAQ. They changed its name from DHX to WildBrain, which, as we know, was the name of its child-focused YouTube business, which was renamed WildBrain Spark. And really for the last several quarters, Ellenbogen has been busy putting the right management and deals in place, and we believe getting the company ready to emerge as a global leader in kids content. They actually reported earnings today. The stock is about flat, or it was flat on the day. It's up barely, which is shocking to me. I thought the stock would be up 30, 35%. They announced a great quarter. I'm so excited about this investment. But, if you look at this next page here, I would recommend that everybody go and listen to a replay of the conference call. I'm telling you, Eric Ellenbogen, he's a stud. He's done a great job. He's going to do a great job with this company. I talked about what we look for in businesses: a strong management team. Like I said, Eric Ellenbogen, he has a proven track record in kids content. You can see he was the president of Marvel, left Marvel after it sold to Disney. Then he founded Classic Media, which became one of the largest private owners of branded kids content. He sold that business to DreamWorks Animation. And then at DreamWorks Animation, he became the head of TV. And then he sold that business to NBC Universal. As we know, he's now the CEO, like I said, at WildBrain. He's been there for a year. There's a committed institutional shareholder base. This is outdated. Fine Capital Partners owns about 40% of the company today. But I think, I boxed this bullet point right here. This is from the proxy statement. But keep in mind that right now, WildBrain, the stock price is like $1.12. It's $1.12. I would keep in mind that 50% of Eric Ellenbogen's cash compensation, he's required to use half of that to buy stock. And then that's 50% of his compensation, and he has to use 50% of that to buy stock. The other 50% of his compensation is stock-based. Well, half of that stock-based compensation is paid in 3 equal tranches. And then the other half, the other 50%, will vest as follows. And keep in mind that it's $1.12, the stock price. A third on the achievement of a stock price of $7, a third on the achievement of a stock price of $9, and a third on the achievement of a stock price of $11. I don't know that I've ever seen CEO compensation tied to stock prices that are so far from being in the money. But I think it should give you some confidence in, where he thinks, where we think, where Fine Capital thinks this business is headed. Two, I talk about strong competitive moat brands. I think this is very important for anybody that has looked in the kids content or I guess the small cap content space before. It is just littered with tons and tons of content companies that have never done anything but lose money for shareholders. And a big part of that is because these are companies where 99% of revenue is tied to content production and nothing is tied to consumer product sales. So I think that really, weighs on the importance of evergreen IP, the importance of evergreen franchise brands. And you can see here that I write, with dozens of media platforms for kids, original content based on franchise evergreen brands is paramount. And you've seen this with, the biggest content, kids content company out there, Disney. Part of why Bob Iger has had such a great stint at Disney, and you've seen it, he's gotten away from a lot of these one-off theatrical releases, and he's really focused on the franchises where you can make a first and a second and a third, and that's all tied to high margin consumer product sales. But right here, most of Pixar's movies have been hits, but on a pure theatrical release basis, they're not all financially successful. Given that a studio retains about half the box office haul, the theater gets the rest, and then the marketing budgets are huge. It's roughly half the production budget. The actual content production profit is surprisingly low. And the case example I use here is Disney's Cars. So Cars is arguably, one of the top 5 Disney franchises of all time. And it's estimated that Cars 1 made $120 million profit for Disney, and Cars 2 lost money. That's not very impressive. However, from the sale of lunchboxes and stuffed animals, video games, bed sheets, and all of that consumer product stuff, the Cars franchise has generated global retail sales in excess of $20 billion for Disney. So I think when it comes to content creation, and once again, this is the knock against a lot of content companies, it's fair to think of a TV show or a movie as just a big commercial. And the only proof that your brand is evergreen or has a moat characteristic is translated into consumer product sales. And I would say that a small percentage of most content companies and I mentioned this earlier, a very small percentage of consumer product sales are based on IP. And that would either suggest that A, it's not a franchise property, or B, management has just done a horrible job executing it and knows nothing about that whole 360 consumer product extension. And I think in the case for Wild Brain, it was probably a little bit of both. So what is, does Wild Brain, do they have a strong competitive moat? And like I said, that was one of my biggest detractors from the company early on. And that all changed in 17, 18 when they bought the Peanuts franchise. And, like I said, the Peanuts property, I believe, is a tentpole property that demonstrates that franchise brands can live on and prosper for years into the future. Peanuts was created as a comic strip in 1950, and today, 70 years later, kids are still discovering that brand every day. And I did mention, right, that maybe this brand is kind of stale. How can you reinvigorate that brand? And you talk about feather number one and Eric Ellenbogen, or arrow number one and Eric Ellenbogen's quiver was the newly announced Apple TV partnership when he came to Wild Brain. And that Apple TV partnership will only give the Peanuts franchise a fresh makeover, and I think make the IP more relevant today than ever before. And they signed a deal with Apple TV. It's a multi-year, multi-project deal, creating content exclusively for Apple TV. They just last year released their first installment of IP and Snoopy in Space in partnership with NASA. It was a hit, one of Apple TV's most watched shows. It won a daytime Emmy. I think that this is going to lend itself to giant consumer product sales down the road. And as I hear on the bullet point, that second bullet point talks about how Licensing Letter, a leading industry trade publication, ranked Peanuts as the world's sixth largest character brand based on retail sales. And that's ahead of big brands like Paw Patrol, Frozen, and Peppa Pig. And this is obviously before Snoopy in Space. So just imagine, the possibilities. I think it could just be huge. And, that second income stream from consumer products is giant. And you could see that these attached consumer products, I write here, they're like oil wells that never cease pumping cash and include everything from toys, music, publishing, stationery, food products, school supplies, and on and on. So I believe that just based on the company today, tied to the valuation, right? That price is what you pay, valuation is what you get. This is a cheap company. It's trading for 8 times EV to EBITDA multiple. Just based on today and Peanuts alone, I think this is a home run investment. Now, what makes this the 10 or 20 bagger would be what they could do with their other IP. And you go to this next page. So they have Peanuts. Eric Ellenbogen talks a lot about this on the call. He talks about how what they're doing with the Peanuts franchise and what they're doing with Apple TV and Snoopy in Space and a lot of the new content. It's bringing the top creators in the industry to Wild Brain and really kind of unveiling a lot of the other IP that they have. So these are examples of other IP that they have. And I think this is significant. So, one of their brands is Strawberry Shortcake, which they bought from Iconics when they bought the Peanuts franchise. And unlike Peanuts, where they only own 40% of it, Sony owns the other 40%, and the Schultz family still owns 20%. So that consumer products revenue and production revenue is chopped 3 ways. Well, with Strawberry Shortcake, they own 100% of that brand. Strawberry Shortcake is a defunct brand, and anybody that remembers that from the early 90s, it was huge. It was a huge brand. It's a defunct brand. There's been no meaningful content been created for that brand in decades. And Wild Brain is in the process of redeveloping that brand and reintroducing it on their AVOD network, Wild Brain Spark. And keep in mind, on their AVOD network, they control that distribution too. They're not giving up rights to maybe an SVOD player or anything like this. And I think this is really important. Like I said, Strawberry Shortcake is a defunct brand. What are Strawberry Shortcake's possibilities? I don't know, but you could read here that in the 1990s, Strawberry Shortcake was first introduced as a 1-hour home video project for 20th Century Fox Home Entertainment. They spent the owner of that IP at the time spent $250,000 creating that content. Over the next 5 years, Strawberry Shortcake did $5 billion of retail sales with 300 licensees and 600 products in the marketplace distributed worldwide. I'm not guessing or assuming that they get back there, but you could see the possibilities if you could even get somewhat back there. This other example here, Teletubbies, on Eric Ellenbogen, they own Teletubbies. On his first call, they own 100% of it. On his first call as CEO in mid-19, he talked about, the new 360 approach to brand development. And on that call, he highlighted how Teletubbies, which was, despite what you think of the brand, it was a huge, huge success in the early 2000s. Over that prior year to Eric Ellenbogen getting there, Teletubbies had done less than $1 million in consumer product sales in that prior year. This was a brand that, once again, was doing several $100 million per year in retail sales. And that's just two. Down below, there's multiple others. They have a new Project Revenue here that they're distributing on their AVOD platform. Right now, they have two pieces of IP on Netflix, Johnny Test and Chip and Potato. They have some with linear broadcast. But I think as they build these brands, and Eric Ellenbogen actually talked about it on the call this morning, he said, we start with the content, we'll chase with the consumer products. So build the content, make the content resonate, and then you could chase with the consumer products, further down the road. And I think they're in the early stages. I think a lot of content companies, and it's been proven, they launch toys and consumer products too early. That's what happened with former management. They did a Teletubbies launch several years ago, and it didn't work. It flopped. And part of the reason it flopped is because they led with consumer products way too early. Ellenbogen, he dropped a great quote on the line today. He said, if it grows like a weed, it usually is a weed. So, develop the product and then chase with consumer products after the point. Now, this is, to me, the business is exciting based on their own content. This is the most exciting piece about the business, and this is the breakout business, WildBrain Spark. Several years ago, WildBrain started producing AVOD content, which stands for Advertising Video on Demand, on YouTube and on Amazon, on the different AVOD platforms. And they have had they've had such a great success with it that now they're doing it for third parties. And with a lot of these third parties, they take a slice. They're hired as channel manager, but they take a slice in consumer product sales. You can see that they now feature more than 225,000 videos for over 650 kids' brands in over 20 languages. Now, this is really crazy to me. 1 in 3 kids worldwide with access to YouTube watch video content on WildBrain Spark, which is just insane. And if you look at these two graphs below, you can see how quickly views are growing and how quickly revenue tied to this AVOD effort has been growing year over year. It's a huge growth business. At some point, it will be the biggest piece of the business. And that's when I think people start valuing this as a growth company, as a growth tech type company, rather than a stable consumer products company. It's a breakout business in 2 ways. The first way would be the massive advertising opportunity. Eric Ellenbogen has talked a lot about on previous calls, and he talked a lot about it on the call today, that he's been in this business for a long time, and 100% of the time, and it's always been this way, advertisers follow eyeballs. And right now, the kids content space, there's $4.5 billion per year of advertising money spent in kids. And I believe that WildBrain Spark could attract a nice portion of that, based on that whole comment about advertisers follow eyeballs. And you could see right here, WildBrain has a very compelling pitch for advertisers. Spark has an average of 4 billion viewers per month, and that compares to Nickelodeon with 1.3 million daily viewers, Disney with 760,000 daily viewers, and Cartoon Network with 640,000 daily viewers. And you can see this chart I put together. I think you put that in front of any advertiser, you're going to have great success. They hired a guy recently just to kind of Charles Gabriel to lead the push and to direct advertising. And I think the opportunities are huge. And this becomes a massive growth industry. I think another area in which this is an exciting breakout business is as a brand builder and a discoverer of third-party IP. So due to the success with their own brands that I talked about, like strawberry shortcake and peanuts, dozens of third-party brands and toy companies such as Playmobil, Smurfs, and several others, they've turned to WildBrain to develop their AVOD strategies. Ellen Bogan has referred to WildBrain Spark as a brand builder. And by doing this, the company can identify and then partner with new content that kids want. This content can be produced quickly at 1/20th the cost of a cartoon for TV because YouTube cartoons are shorter and of varying qualities. And that means the production can be profitable rather quickly. And then I think furthermore, and this is important, WildBrain's analytics tools can test that new IP, see what's gaining views, and then partner with those content creators and IP owners to bring that content to a broader audience and potentially partner in consumer product sales. So these are just two examples that I think are just incredible. So Universal has this huge vault of old stodgy kids content, and one example here is Woody Woodpecker. And they've done nothing with Woody Woodpecker in decades. So WildBrain launched so they partnered with Universal, and then they launched Woody Woodpecker YouTube channels in Brazilian, Portuguese, and Spanish. Those channels immediately resonated. The Portuguese channel for Brazil was a breakout hit. The Brazilian channel organically attracted 2 million subscribers, and the Spanish channel over 700,000 subscribers, coupled with extremely high engagement. And this has led to the opportunity to create new content. And Woody Woodpecker is like now one of the top family brands in Brazil because of what WildBrain Spark has done. The second example of Sunny Bunnies, you can see so Sunny Bunnies, it's a Russian-owned piece of kids IP. And after season 1, the official Sunny Bunnies YouTube channel had 1,200 subscribers. And this is after season 1, they were on the Disney Channel just in Russia. Their YouTube channel had 1,200 subscribers. So wanting to expand the brand, the creator approached WildBrain as channel manager. WildBrain's team of talented YouTube experts, they transformed the Sunny Bunnies channel from 1,200 subscribers to a top 1% global YouTube channel. WildBrain was able to generate more than 600,000 views per day and grew the channel to 325,000 subscribers and 1.8 billion minutes of watch time. And leveraging the success, Sunny Bunnies was able to secure a master toy partnership, and earnings from that channel have funded further content development. And Disney actually bought Sunny Bunnies about a year ago. And then you could see these are just a bunch of other examples. That's just the beginning. It's just getting started. Just recently, they've announced with like 3 different toy companies. These toy companies are launching this new toy concept, and they're creating content first. WildBrain's creating content first on WildBrain Spark to grow the brand, and then it will follow with toys and products. And these are all brands at this point where WildBrain's going to have a significant piece of consumer products revenue. So, Eric Ellenbogen, he said early on, is WildBrain going to discover the next hit in kids content? He said, no, but we will likely have the next hits, plural, in kids content, meaning that, you never know what's going to resonate. People waste a lot of money and energy trying to create the next big hit that will resonate. But because of WildBrain's scale and size, and no one else is doing this, they have the ability to identify what kids like in all the different parts of the world, and then partner with that creator to then identify the next big hit. I think the opportunity is gigantic. And think back to the strawberry shortcake example, where that one small investment resulted in $5 billion of consumer product sales over the following years. So once again, lastly, valuation. I think the company's cheap. It's trading at about 8 times EV to EBITDA multiple. They announced earnings today. Net income, cash flow growing significantly year over year. It's crazy to me the stock price isn't up. The big knock against the company is it has a lot of debt. Right here it says 5.1 net leverage ratio. That's declined significantly. But I think what's important when a company has debt is, can they service that debt? Can they pay down that debt? And in WildBrain's case, they can easily service it, and they have multiple means of reducing that leverage ratio. And I think it's only a matter of time before that happens. Then lastly, so anyways, so that takes you to 69% of our portfolio. And the last thing I want to talk about is Raphael Holdings, and that takes you to close to 75, 80% of our portfolio. I am super excited about Raphael Holdings. It might sound speculative at first, but once again, get back to what I said about situations where it's just the risk return is so asymmetric. And this is clearly the case here. I do not think it's very speculative. I am super excited. I talk a lot about owner managers. One owner manager that we have followed for many years, and I think he just has an incredible nose for opportunity, is a guy named Howard Jonas. Howard Jonas founded a company called IDT Corporation in 1990 as a provider of a call reorigination service. So a telecom company. He took his company public in 96 and built it to the point where today it generates 1.5 billion in revenue per year from the sale of communications and payment services. He's had a lot of success in telecom, but he started talking about close to 20 years ago about how, telecom's just a commodity and he wants to, own IP and own other assets. And he's been incredibly successful at creating value for his shareholders by using the cash flows from the core shrinking business to fund a wide array of growth initiatives. And you can see here in the past decade, IDT has spun off 5 public companies. He sold the 6, after which it provided a special dividend. I would note that we own all of these spinoffs. Raphael's the largest exposure, and it's the one that we're most excited about. Had you invested in IDT Corporation in January of 2010 and kept each of the spinoffs, an investment in IDT plus the SpinCo has generated roughly 45% annual returns versus 10.8% of the S&P 500. So clearly Howard Jonas has a track record of success and a track record of allocating capital effectively. I think it would heed any investor well to just at least pay attention to what he's doing. You could see, I hear you have access to the presentation later. You could see some of his bigger successes. His biggest success was a company called Straight Path Communications, which some of you may recall. But in 2001, Jonas bought a swath of U.S. aero spectrum licenses for $56 million from One Star Communications out of bankruptcy. He spun those assets off into Straight Path Communications. And in May 2017, he sold Straight Path to Verizon for $3.1 billion. So pretty incredible. Paid $56 million for those assets, sold it for $3.1 billion 18 years later. So, I think what's hard for a lot of people when they follow these great owner managers is, 18 years is a long time, but look at that return. And that return didn't come evenly dispersed over those 18 years. Shareholders, I think it was spun off in 2013. It was spun off in 2013, and shareholders, had to go through a lot of volatility before it was sold in 17. So, we believe that Howard is just in the early innings of his business success. Right now, several of his spins, Raphael, IDW, Zedge, Genie, they're all publicly traded. We own them all. I think IDT still has several breakout businesses that they're going to spin off in the future. Net2 Phone, which is a UCaaS business, National Retail Solutions is a point of sale network, and Boss Revolution is an international money transfer business. I think all of those eventually get spun off. We'll own all of those. Like I said, our largest exposure is Raphael Holdings. So Raphael, it's a little different. Once again, doesn't have a whole lot to do with telecom, but it's interesting. And how I think it's interesting to note that Howard is obsessed with Raphael. He spends 99% of his time thinking about Raphael, and it's become a pretty incredible company. But just to give you a little background, Howard was shortly after one of his big monetizations, he was introduced to someone on the business operations side of Raphael. And this is, I think, like back in 2011. And, Raphael Pharmaceutical, they were a cancer company. And they were working on a drug based on a science called altered metabolism. So just to give you a quick background on altered metabolism, Chemotherapy is highly effective on cancers, but it's toxic to a lot of people and kills them. They can't stand the toxicity. Uh, then you have immunotherapy, which is highly effective but doesn't work on all cancers. So, cancer metabolism is a new class of treatment, and this treatment, the medicine targets the mitochondria of just the cancer cells and leaves the healthy cells alone. And it's usually used as a combination medicine. So, Howard was introduced to this business operations guy years ago. Thought it was interesting. What a noble cause, trying to cure cancer. Howard was pre-med in college, has always had an interest in medicine, had the capacity, and just trying to be a good uh, do-gooder for society. Said, hey, if you need a board member, I'd love to help. And I always joke around and say you can never have enough billionaires on your board. So Howard joined. Joined the board in 2013. At that time, I don't think he necessarily had any visions for what this could become. But fast forward several years, he saw the advances that they were making. And in 2005, the company was running out of cash, needed cash. Howard brokered a deal where he forked over a large amount of cash in exchange for roughly a 50% or 56% majority stake in Raphael Pharma. And he took that ownership underneath the IDT umbrella. So once again, has it under the IDT umbrella. He has a lot of venture investments under the IDT umbrella. Some of those grow up and he spins off, some of them don't. But over time, he became more and more enamored by what they were doing, saw the results of what they were doing. And you could see here in the second half of 2018, he decided to spin off Raphael Holdings from IDT Corporation. And you can see Raphael Holdings was made up of Raphael's real estate, their majority stake in Raphael Pharma, and another majority stake that they have in a separate biotech company called Lipomedics. So at the time of the spin, what was really interesting, if you just looked at the balance sheet, the carrying value of the real estate was about 100 million, and the market cap was 100 million. So you're basically buying the real estate at book value, and you were getting the farm asset for free. That's not quite the case today. The market cap's about 300 million, but still a third of the value is in the real estate. Now, this is what got Howard really excited. And this is when he decided to spin off the asset. So Raphael's lead compound, CPI 613, it's achieved multiple and lasting remissions from some of the most difficult to treat form of cancers. They've been given 5 different orphan drug designations, and they have 2 phase 3 trials, in one in pancreatic cancer and one in AML. And this is a little outdated. The phase 3 trial for pancreatic cancer was actually just announced to be fully enrolled, and they should be expecting interim analysis really any day, any month, which could be a huge catalyst for this company. But I think what's interesting about, and like I said, he saw these results in the phase 1 trial before spinning off Raphael Holdings, and this gave him the conviction to spin it off. But in phase 1 clinical trials at Wake Forest Baptist Medical Center, so Raphael dosed 18 patients with CPI 613 that were having stage 4 metastatic pancreatic cancer. One thing that I would note is, pancreatic cancer, as many of you may know, is a death sentence. The survival rate is less than 1%, and it's a cancer that is incurable, and many people have given up on it. So in phase 1 trials, Raphael dosed 18 patients, and out of those 18 patients, here it says there were 3 complete remissions. There were actually 5 complete remissions, which is incredible, very incredible. And you could see that the objective response rate was 61%, and that compares to FOLFIRINOX by itself has a complete remission of less than 1% and an objective response rate of 31%. So in the phase 1 trials, like I said, the complete remission rate is unheard of, and the objective response rate was double. And really exciting. The FDA urged them to go straight to phase 3 trials. They launched phase 3 trials for stage 4 pancreatic cancer in combination with FOLFIRINOX. This has 14 locations. I think it was 17 locations and 500 patients. They just announced a couple of months ago that they were fully enrolled. This is about a year ahead of schedule, which gets you really excited. That's very rare, particularly in this COVID environment. And this is something that could be huge. And, if it is, just to kind of walk you through how I think about valuation, the average treatment cost for a cancer drug that's patent is 12 to 15,000. 65% of the patients are living over a year. So that gets you to roughly $140,000 per treatment. So just to lowball that, say 100,000 per treatment. There's 60,000 pancreatic cancer patients every year in the United States. If this gets approved, it's the standard of care. This becomes a $5 to $6 billion drug, and big pharma would typically buy an asset like this for 3 to 5 times. So just taking 3 times, this gets you to a $15 billion drug. Raphael Holdings owns half of it. That's $7.5 billion. This is a market cap of 300 million. So, the upside is gigantic, and the downside is somewhat protected by the fact that they have a third of the market cap in real estate. And then I would also, mention that they own the other biotech asset, and then they just created something called the Bayer Institute, which is kind of their next generation pipeline. The Bayer Institute is named after Saul Bayer, who founded Celgene and sold it to Bristol Myers, and they're working on some really exciting things there. And keep in mind, this is just pancreatic cancer. This is interesting. So if you look at this picture right here, this is Raphael reading the bell on the floor of the New York Stock Exchange. Howard Jonas is in the middle there in the red tie, and you could see to his right, that is Earl Grassi, and to his left is David Wingo. And both were people that registered as actually objective response rate patients in the phase 1 trials. That's why I said it was 5, because neither of them were included as complete remission, because they had just joined the trial, and today they would have, one of them has passed away, but they would have filtered into that complete remission category. So Earl Grassi, who's there on the right, he has a blog that he keeps. It's actually pretty interesting. You should go read it. It's www.cpi613.com, and he talks about his experiences, his testimonies, a lot of the other patients on the trials. I think he just underwent like his 110th treatment, and he's feeling good and traveling. And like I said, these sort of results, really, it's statistically important.
Hey, Graham. Hey, sorry about that. My laptop died, but I basically got through it all. So if you could connect me in, I can keep on talking. No, that's okay. And I don't know if I'm being recorded. I got through most of the presentation, and like I said, that exciting. And the only thing I didn't get to is I talk about a out licensing partnership they had in Japan with Ono Pharmaceutical, which is one of the largest pharma companies in Japan, and they wrote them a check for $12 million up front and $150 million tied to certain milestones. So I think that's another thing that kind of maybe mutes some of the downside. So Raphael, It's a company led by incredible management. The chairman, Howard Jonas, is really just the visionary. If you look at the doctors and the medical people associated with the company, it's some of the brightest minds in medicine. And like I said, they've completed phase 3 trials, and that's just for pancreatic cancer. And there's all sorts of other indications I didn't even talk about. So that's another great example of, like I said, just being aligned with great management, looking for situations where the reward risk dynamic is very asymmetric. So they're between Raphael and Wildbrain and the uranium companies and gold. That's a huge part of our portfolio, and I'm just beyond excited about all of those investments.
For sure. Well, in that case, we can go ahead and jam through these couple of questions we have here real quick.
Yeah.
I'll go ahead and feed them to you, and we'll get some quick answers from you.
Great, thank you.
Alrighty, so looks like first question we have here. Any thoughts on the upcoming election, impact on markets, anything like that?
Not really. We try to. Obviously, you need to have an opinion. We try not to get too macro in terms of our thoughts on the market, and that's why we try to own things that we think could do well either way. I do think, as far as it relates to the gold investment, I just do think the uncertainty and the social unrest, and it just seems like a huge percent of the population is just very angry with their lot in life, and I think that really plays into to assets like gold.
Gotcha. And moving on to our next question, and I think we have a fairly confident answer in this already, but it's looking like the future for uranium, in your guys' opinions, pretty blue sky. Things are looking good.
Yeah, very much so. Like I said, we're at a situation now where a lot of the long-term contracts between the miners and the utilities have, they've begun to roll off. They continue to roll off, and the utilities, they need to secure new supply, and the producers have been buying from the spot market to deliver into those contracts, and there just isn't a lot of material there. So it's not a matter to us of if, it's when, and we think it's close.
Gotcha. And you mentioned during the presentation there's some funds and investors that you like to follow. Would you mind highlighting 2 or 3 of them?
Yeah. So there are a lot. So the obvious one is something like Berkshire Hathaway, and the only point there being, we're not going to go buy Japanese trading companies because Berkshire did, but they're smart. They do a lot of great work. I think it's very it just makes sense, right, to try to reverse engineer that idea. Now, ultimately, you need to make it your own idea. You can't abdicate your research efforts to someone else, but it just makes sense to try to, like I said, see if you can see what they do. In terms of ones that we watch, so I'd say in terms of the 13F filings, it's names like Stan Druckenmiller and Ray Dalio and Berkshire Hathaway, Fair Home Fund, Fine Capital. But I would say probably more so than names like that file 13F holdings, it would be more attributed to kind of people that I've talked about, developing a network with over time. And a lot of them are smaller fund managers, but there's a lot of great ones. There's some are so small you've never heard of them, but then there's smaller ones like Stephen Keel at Arquitos Capital Management, Scott Miller at Greenhaven, Laughing Water Capital Management. There's a number. There's a big list of people that I have kind of in my network, and I just think they're smart and they do a good job, and I'd be foolish not to try to look at what they own and understand their thesis.
Definitely.
Anyway, and by the way, the one other thing that I would note is, in terms of, Guru Focus, that's one area where I think, Guru Focus and your service is great. I mean, you've identified a lot of those, great managers and capital allocators. And then in addition to other managers, I would say, keep an eye on certain capital allocators, and a lot of these guys are business leaders, but, like John Malone. Anything John Malone does, I think, is interesting. The Liberty Media Complex. Barry Diller at IAC. I think anything that Barry Diller at IAC does is interesting. Barry Diller, he basically built the Expedia and travel platforms. He built the dating, the match group. And today he's still at it. The biggest piece of IAC today is Angie Home Services. And then he, owns a bunch of, app businesses and Vimeo. And there's no one better than IAC at a lot of these, business to business and business to customer digital platforms. So I would say anything that IAC and Barry Diller do. Howard Jonas, I talked about Howard Jonas. We talked about Raphael, but a lot of his other companies are interesting. Zedge, IDW Media, which is a comic book content production company. A bunch of businesses, in particular the Net2Phone business, which I imagine he'll spin off at some time here. You look at that UCAS business and look at the valuations that a lot of these UCAS companies like Ring Central and 8x8 get, and once spun off, Net2Phone could easily have that same sort of valuation. People like other names like Bill Sturritz, Eddie Lampert. I think people think Eddie Lampert's the village idiot with his Sears debacle, but he's still a smart, driven guy, and I keep a close eye on someone like him. So there's a number of people. One book that I would recommend. Many of you may have read it, but it's a book called The Outsiders, and it was written by Will Thorndike, who's a professor at Harvard Business School. And in the prologue of the book, he talks about what makes a great CEO, and he talks about Jack Welch from GE kind of being what most people think was a great CEO, and his point is Jack Welch was a good CEO, but he wasn't even in the same zip code as a lot of the guys he talks about in these chapters. And he has a chapter on like 8 different guys, and one was Bill Anders at Capital Cities, one's on Warren Buffett, one's on John Malone, one's on Henry Singleton from Teledyne, but really talks about how the most important job of a CEO, chairman, is capital allocation. So your business generates cash. What do you do with that cash? Do you invest it in your business? Do you buy other companies? Do you pay down debt? Do you pay dividends? And the point being that the capital allocation you use, the capital allocation tool that you use at different parts in that company's business cycle greatly impact the results. So that's very much how we think about companies and managers that we invest in.
Definitely. And when you're looking at a company trying to determine growth, are there any specific factors you're looking at, or are you making big predictions?
No, not really. I think, ideally you look for a company that's, growing revenue, growing earnings, growing cash flow, doing it all. And, that's one reason why I'm so excited about, our investment in WildBrain. So WildBrain really kind of checks all the boxes. So revenues declined year over year, but if you listen to the last call, I think it's very evident that will soon be growing. So you're going to have a company that's, like I said, growing earnings, or growing revenue, growing earnings, growing cash flow, paying down debt, and it's a business that is in an industry that is experiencing, great growth tailwinds. But I think if you could find something like that, I mean, the more the better. And then obviously valuation is paramount. so you don't want to overpay for that asset, right? Price is what you pay, value is what you receive. So I think it's great to get growth, but not when you have to sacrifice value.
For sure. And do you have any opinions on the current state of nuclear waste destruction or disposal?
Yeah, so it's pretty interesting. I think that there's been a lot of fear mongering, a lot of misinformation that has been spread, and in terms of the waste, one thing. Well, so I would say first off, a lot of people have this perception of nuclear waste being like green ooze that gets into the atmosphere, and I don't know whether that's from watching The Simpsons or something like that, but it's not true. These are like little steel pellets that go into these fuel rods, and it's the safest and the cleanest. And in terms of the waste, so in a nuclear power plant, a fifth of that fuel is replaced every year. Well, that fuel, it's stored in large pools inside the plant, and for 1 year, and over the course of that year, it loses 90% of its radioactivity. At that point, it's stored in steel caskets, and it's stored on site in that nuclear power plant. And they say over that period of a couple of decades that it's stored in the plant, it loses another 90% of its radioactivity. So at this point, it's lost like 99.9% of its radioactivity. And then it's stored, I think, like 3 or 4 miles underground into bedrock and steel caskets. And they say all the nuclear waste ever produced like in the United States can be stored on like in a basketball gymnasium, stacked a couple of yards high. So clearly that needs to be addressed, but I think it largely has. I think a lot of the storage situations for that waste, it's safer than people think. And like I said, I think you've had a lot of fear-mongering tactics from environmentalists, but one thing that you see changing fast is it's kind of starting to become this kind of like bipartisan support for it as a fuel source. And at one point the Trump campaign was very pro-nuclear, and the Biden campaign was kind of anti-nuclear, but I think a lot of that had to do with Republicans and Democrats can never agree, and you just take the opposite side. And as the Biden campaign, as we get closer here, and they've are forced to study climate change, and it's a bigger issue today than ever before. The drumbeat's growing louder and louder. I mean, now the Biden campaign might even be more pro-nuclear than the Trump campaign. So I just think this is like a multi-decade, I think, growth scenario.
For sure. And one of the viewers was wondering why you have the GDX ETF on top of gold miners.
Right. So the GDX. So actually, what that GDX position was, we bought kind of deep out of the money call options on the GDX, and it was kind of like a call option on the gold price, a magnified way to kind of play that. So that's been a great investment for us. When you look at our 13F filings, it's a little misleading because when you own option positions, it shows up as like your notional exposure. So I think that the GDX position shows up as maybe like a 30 or 40% position in our 13F filing, which is not the case. That's the notional exposure.
Gotcha. And any thoughts on the Kirkland Lake Gold mining company?
I think it's a great company. Low, all-in sustaining costs. We like the management team. I would just say in general, all these gold miners will do well in the environment that we think we are going to see in gold. And then it's up to us to pick the best companies, and we just think Kirkland Lake is one of the best, in the industry. And I would also, note that an important thing to us with gold miners would be, not only great management, but owning companies that have their reserves in what we think are government-friendly jurisdictions. The last thing we want to do is wake up one morning and find out that the gold mine has been, confiscated by the government, and you've seen that with other companies. So I think the ones that we own, their reserves are in like I said, friendly regions of the world, and high quality mines, run by good management teams.
For sure. And when you're looking at margins, do you focus in any one place, say gross margin or operating margin, net margin, anything like that?
I think it's all important. I think I probably tend to focus most on operating margins, but like I said, I think it's all important. And definitely look for companies where there are high margin opportunities. To go back to Wildbrand, one of the reasons I get so excited about that is, the companies today, the margin profile is attractive, but if they do land on a couple of these hits, that lends itself to consumer product sales. And I don't think there's a better business to own or a better business to be in than being an IP owner of a great product or franchise, because that's just about 100% margin business.
For sure. And if you have a 10-year investment horizon in a company, would you ever consider buying a stock if the share price dropped 5 or 10% and then reduce your cost basis by buying any future share price drops?
Yes, but I think we try to stay away from trimming and adding to positions too much. I think after tax capital return, that's the ultimate measure, and if you trade around it too much, you erode into a lot of that. So I guess yes, but we try not to get too fancy. If it's a great company, buy it, and then I guess closely monitor that business's growth, but understanding that value is always changing, and try to own businesses for the long term, and don't worry about short-term stock fluctuations.
For sure. And getting on to our last question here, when you're looking at cash flows, is there a particular one you like to focus on, whether it be from the cash flow statement or operating cash flow as the cash flow, anything like that?
Well, I think free cash flow, right, it would be the ultimate measure, but that's a measure that can't be manipulated by earnings. But I think all valuation metrics are relevant, and once we when we value a company, we kind of focus on traditional valuation metrics, and like I said, they're all important.
Definitely. Well, that'll wrap up our questions here. So I'd like to, put out a big old thank you to all those out in our audience that have been hanging out with us and bearing with through all of our technical difficulties that we've had, but we made it through it. And I'd like to thank you, Joe, for the great presentation and for taking the time to answer these questions and spend some time with us.
Yeah. Well, thank you very much, and I apologize that my laptop kind of cut off for a second, but hopefully it wasn't too much of a disruption as I try to call in right away.
Definitely. And to all the audience out there, if you missed any part of the presentation at all, there'll be a full recap video available both here on YouTube and on GuruFocus.com, and we hope to see you next week for another featured guest, and hope you enjoyed today's presentation. And from us here at Guru Focus and out to you and our audience as well, Joe, we hope that everybody can just stay safe out there and stay healthy in these times.
Thank you, everybody.